Hello, English learners. Welcome back to English Pod. My name is Marco.
And I'm Erica.
We're bringing you an advanced lesson today.
That's right. An advanced lesson where we talk about investing in emerging markets.
Right. So it's kind of a business topic. It's kind of a world topic as well.
Yes.
And it's pretty difficult.
Yeah, it is really hard.
Right. So if you're listening and you don't understand everything, please don't get discouraged. Don't worry about it because we're here to learn.
Yes, and we're here to help you.
Right. Mm-hmm. So let's get started with this. I'm really excited about this lesson.
Yeah. Okay. Well, Marco, maybe you can tell us a little bit. What is an emerging market?
An emerging market is a market that is starting to develop.
Okay.
And it's growing rapidly.
So you can maybe give some examples of emerging market.
Well, for example, China is an emerging market.
Yeah.
In the last years, it's been growing rapidly.
More and more people are moving to the middle class and have money to spend.
Right, exactly. Mm-hmm. So China is like a really great example of an emerging market.
All right, well, with that, let's listen to the dialogue for the first time.
Dad, I'd like to borrow some money.
Sure, Johnny. How much do you need? $5?
Come on, Dad. I need $30,000. I want to get into the market. You know, I'm tired of hearing all this news about the economic downturn, the inevitable recession, people stuffing their money in their mattresses. I look at this as an opportunity. This is a chance for me to get a jump start on building my nest egg.
I don't know about that. With all the uncertainty in the markets right now, it'd be a very unwise decision to invest. I don't know if you're aware, son, but there has been a lot of turmoil in the markets recently. There have already been 500,000 layoffs in the last few months, and we have no idea how the proposed stimulus package will impact upon the economy. There's just too much instability. I just wouldn't feel comfortable investing in this climate.
But look at it this way. Every challenge is an opportunity. And anyway, I'm not talking about investing in the domestic market. There are emerging markets that promise great returns. Look at China, for example. They have 1.4 billion people, 500 million of whom have recently entered the middle class. Here alone, the aggregate demand for consumer goods represents an amazing wealth-generating opportunity.
Oh, come on, son. You're looking at this too naively. The Chinese market has exhibited a great deal of instability, and their currency has been devalued by almost a whole percentage point.
Fine then. If that's the way you feel, so be it. But you're losing out on a great opportunity here. I'm gonna hit up Mom for the cash.
Well, it sounds like the dad has missed out on a really big investment opportunity, hey?
Yeah, his son is pretty smart.
Yeah.
Pretty smart little boy.
Uh-huh.
Okay, so we have some great words that we want to look at here. Mm-hmm. Why don't we start with the first one? Turmoil.
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 So we have some great examples of how turmoil is used in different sentences, so let's listen.
Example 1. With a civil war, a famine, and inflation, the country has been in turmoil for 10 years. Example 2.
There's been a lot of turmoil in my life recently. I've moved to a new city, I've changed my job, I broke up with my girlfriend.
Example 3. The devaluation of the dollar caused a great deal of turmoil in the markets.
So turmoil is a state of
uncertainty, of change, of difficult times.
A little bit of chaos.
Yeah. So, for example, when there's a lot of turmoil in the market, that means stock prices are changing drastically from day to day.
Right. Or the economy is in turmoil. There's a lot of problems going on.
Yeah, uncertainty.
Uncertainty. Okay. Good word. All right, and we also saw something really interesting in the dialogue about a proposed stimulus package.
A proposed stimulus package.
So a proposed stimulus package is something that's going on now.
Yes, let's break this phrase down. So we've got stimulus package.
A stimulus package, something to stimulate the economy, right?
Right, so money from the government to get the economy moving.
To get it moving, stimulus package.
Proposed.
It means that it hasn't been approved yet.
Right, it's suggested.
It's suggested, it's an idea. So the proposed stimulus package for the U.S. economy, for example, is $150 billion.
Right. That's $150 billion of American taxpayers' money that the government wants to put into the economy to keep it moving.
To keep it moving, right. So if it works or not, that's still a debate, but it's a proposed stimulus package.
Let's move to our third phrase, aggregate demand.
Aggregate demand.
Aggregate demand.
Aggregate demand.
So demand is pretty clear, but this word aggregate, what's that about?
Aggregate is like a combined, added.
Yeah.
Right?
Yeah.
Aggregate demand. For example, in a country like China, where cities like in Shanghai or cities like Beijing, where more and more people are accumulating wealth, the aggregate demand is increasing.
Right. The combined demand for consumer goods is growing.
Right. More people have more money, so they're spending more.
Yes.
Okay.
You know, Marco, there's a ton of excellent language in this dialogue, isn't there?
Yeah, a lot of good stuff here.
Yeah, and we want to listen to the dialogue one more time. But before we do, we have 3 words for you that we want you to listen for.
Yeah, pay attention to these words. Nest egg.
Nest egg.
Inevitable.
Inevitable.
And hit up.
Hit up.
So from the context of the dialogue, try and see if you can figure out what they mean. But after listening to it, we'll come back and explain it anyways.
Welcome, everyone, to a fresh, practical, and inspiring episode built for smart learners and smart investors alike. My name is Leanna.
My name is Luca.
We're thrilled you're here because today we'll turn a complex subject into clear, confident action, investing in emerging markets.
Quick note, the file you mentioned isn't accessible on my site anymore, so I crafted a brand new dialogue on your topic that's rich, accurate, and classroom ready. If you want me to match your exact script, please re-upload it.
Let's start simple. What do we mean by emerging markets, and why do people talk about them so much?
Emerging markets are countries with fast-growing economies that are not yet developed, like India, Brazil, Vietnam, Indonesia, Mexico, or South Africa. They often have rising middle classes, expanding infrastructure, more internet access, and new businesses scaling quickly.
So the big attraction is growth, right?
Exactly, because growth can mean rising company profits and potentially rising stock prices over time. But growth comes with risks, political shifts, currency swings, weaker corporate governance, and market volatility.
In other words, higher potential returns often pair with higher risk, so we need a plan, not just excitement.
Strategy matters, and for most learners, a simple entry is using diversified funds like broad emerging market ETFs or index funds. These funds spread money across many countries and companies, reducing the impact of any single problem.
That already sounds safer than buying only one stock in one country.
It is safer, but not risk-free. Currencies can drop, regulations can change, and global shocks can shake everything.
So let's build a checklist for smart decisions and use it step by step.
Checklist item 1. Define your goal: growth, income, or diversification. If you're young with a long horizon, growth may be your priority. If you're close to retirement, risk control might lead.
Checklist item 2. Choose your access: broad EM fund, regional fund, single country fund, or a thematic approach.
What's a thematic approach in emerging markets?
You focus on themes like digital payments, renewable energy, e-commerce logistics, or healthcare expansion across EMs.
Themes can be exciting, but beware of concentration risk and the hype cycle.
Methodical. Checklist item 3. Set allocation. How much of your portfolio should be in EMs?
For many learners, that might be 5 to 20%, depending on risk tolerance and existing diversification.
Small allocation, big learning. Start modestly, observe behavior, and add carefully over time. Let's do a mini tour of regions so our listeners can see the map.
Asia first. India, Indonesia, Vietnam, the Philippines, Malaysia, and Thailand are often mentioned for manufacturing shifts and consumer growth.
India stands out with a huge young population, rapid digital adoption, and infrastructure pushes.
Vietnam attracts supply chain relocation, growing exports, and education gains leading to skilled labor pools.
Indonesia has natural resources, a giant domestic market, and a rising fintech scene, but faces policy and execution challenges. How about Latin America?
Brazil, Mexico, and Chile are key. Brazil for agriculture, energy, and financials. Mexico for manufacturing tied to North America. Chile for minerals and stability traditions.
Yet politics and currencies can surprise, so diversify across countries and sectors. How about Africa?
Kenya, Nigeria, South Africa, Egypt, and Morocco each offer unique opportunities. Fintech in Kenya, consumer growth in Nigeria, capital markets in South Africa, and logistics gateways in Morocco and Egypt. But governance, infrastructure gaps, and currency volatility require patience and selective exposure.
And the Middle East.
The Gulf has energy wealth funding diversification into tourism, logistics, and tech, while other countries balance reform, demographics, and development goals.
Let's translate this into classroom English for investors. What metrics should our audience learn?
Learn basic valuation terms: P/E ratio, price to earnings, P/B, price to book, dividend yield, and free cash flow.
Study macro indicators: GDP growth, inflation, current account balance, foreign reserves, and debt to GDP.
Track currency stability, interest rates, and the strength of institutions like courts, regulators, and central banks.
And always compare companies to local peers, not only to US or European giants, because contexts differ.
Remember reporting quality. Audits, transparency, and minority shareholder protections can vary widely.
Consider ESG, environmental, social, and governance factors, since long-term value often follows responsible practices.
Now, let's walk through a sample plan for a new investor.
Step 1. Open a brokerage account that offers international funds with low fees and fractional shares if possible. Step 2. Choose a broad emerging market ETF to serve as your core holding. Step 3. Set a small monthly contribution. Dollar cost averaging helps reduce timing risk. Step 4. Write rules. Rebalance annually, cap single country exposure, and pause contributions only for serious reasons.
Step 5. Define a risk budget. Decide the maximum drawdown you can tolerate without panic.
Step 6. Keep a journal. Note why you invest, what you buy, and how you feel during volatility.
That journal builds emotional intelligence, which can be as important as financial knowledge. Imagine Priya, a 28-year-old engineer who wants long-term growth and global diversification. She puts 10% of her portfolio into a broad EM ETF and 2% each into India and Vietnam single-country funds. When markets fall 15%, she feels nervous but checks her rules and holds steady.
2 years later, her EM allocation has recovered and slightly outperformed her bond holdings, teaching her patience and process.
Her journal shows that rebalancing, adding a little when prices fell, was emotionally hard but mathematically sound.
Her journal shows that rebalancing, adding a little when prices fell, was emotionally hard but mathematically sound.
Listeners often ask, should I pick individual EM stocks? If you love research, sure, but it requires time, reliable data, local knowledge, and a strong stomach for volatility. For most, broad funds are safer. If you stock pick, start tiny, limit position sizes, and write an exit plan.
Watch for accounting red flags, related party deals, sudden debt spikes, and opaque corporate structures.
Also monitor currency exposure. Strong local growth can be erased by a severe currency drop versus your home currency.
Hedges exist, but they add cost and complexity, so beginners usually accept currency risk and diversify.
Let's unpack currency quickly. If your home currency is USD and you buy a fund tracking Brazilian stocks in BRL, two forces drive your result: stock performance and BRL-USD changes. Even if Brazilian companies rise 10%, a 10% fall in BRL versus USD can cancel gains, so review currency history and policy trends.
That's why long horizon and steady contributions matter. The noise of currency cycles often averages out across years.
Another tool, factor exposure. Value, quality, momentum, and size can look different in EMs. Some funds tilt toward dividends, others tilt toward quality companies with strong balance sheets and consistent profits.
Is quality a better shield in volatile EM periods?
Often, yes. Strong balance sheets and governance can cushion shocks, but no factor wins all the time.
So a core broad fund plus a small quality tilt can be a reasonable combo for stability seekers.
Fees matter more than people think. Every extra 0.5% annually compounds against you. Prefer low-cost index funds unless you have high conviction in a skilled active manager with a verifiable track record.
What makes an EM manager skilled in your book?
Disciplined process, risk control, transparent letters, reasonable turnover, and performance through different cycles, not just one hot year.
And watch asset size. Too much money can dilute edge, especially in smaller markets.
Practical habit. Set rebalancing dates, not rebalancing moods, because moods mislead under stress.
Quarterly or semi-annual checks are enough for most people.
On those dates, compare target allocation to actual and nudge back without trying to forecast the next headline. Forecasts feel smart, but discipline wins more often than predictions.
What about risk beyond numbers, the human side?
Expect scary news cycles, social media panic, and friends telling you to sell at the bottom or chase at the top. Your defense is a written plan, small steps, diversified funds, and the courage to be boring when others are dramatic.
Long-term investing is like language learning. Tiny daily practice beats sudden cram sessions.
Let's share a simple 12-month learning path for EM investors. Month 1 through 3, read basic EM primers, learn valuation terms, and pick your core fund. Month 4 through 6, start monthly contributions and write your rebalancing rule. Month 7 through 9, study 2 countries in depth and keep journaling emotions during dips. Month 10 through 12, add a small satellite fund if you want, quality tilt, dividend tilt, or one country you understand best.
At the end of the year, you'll have knowledge, a routine, and a real portfolio to practice with.
Can you give 2 concrete country snapshots our listeners can analyze at home? Snapshot A, India. Large tech services, digital payments growth, infrastructure investment, and a vibrant startup ecosystem. Key risks: valuations can run hot, bureaucratic friction, and global capital flow sensitivity. Snapshot B, Mexico. Manufacturing tied to North American supply chains, nearshoring momentum, and improving logistics corridors. Key risks: policy uncertainty, security concerns, and U.S. demand cycles.
Homework idea. Find one broad EM ETF, one India fund, and one Mexico fund. Then compare fees, holdings, and 5-year performance.
Write what you like, what worries you, and what rule would make you comfortable owning each fund.
We should also warn about liquidity and trading windows, because some EM funds trade with wider spreads.
Use limit orders, avoid thinly traded products, and don't chase price spikes during news events. If you're dollar cost averaging for years, today's penny difference matters less than your overall discipline.
Investing is a marathon with headwinds and tailwinds. Save energy, keep pace, and hydrate your patience.
Another tip: taxes. Dividends and capital gains treatment varies by country and fund structure, so read your local rules. Withholding taxes on dividends from certain markets can reduce income, which is fine if growth is your main aim, but must be understood.
Keep statements, note distributions, and plan your rebalancing around tax efficiency when possible.
Curious, what about frontier markets? Smaller, earlier stage economies even less developed than EMs. They can offer unique growth stories and diversification, but they carry higher liquidity and governance risks.
If you go there, keep allocations tiny and use specialized funds with transparent methods.
For the motivated learner, corporate earnings calls and investor presentations are gold mines of context. You'll hear management discuss currency, regulation, and strategy. Just remember, they're salespeople, so verify with independent sources.
Cross-check with reputable research, development bank reports, and statistics agencies to balance the pitch.
Mindset time. Successful EM investing blends curiosity with humility. You accept that you can't know everything, so you diversify, automate contributions, and learn in public with a long horizon.
Celebrate process, not headlines. Your future self will thank you for calm choices. Before we wrap, let's build a one-page EM game plan our listeners can copy.
Goal: global growth and diversification over 10+ years. Core: one low-fee broad EM ETF at 10% of portfolio. Satellites: up to 5% total across one quality till EM fund and one single country fund you've studied. Process: monthly contributions, semi-annual rebalance, and journal entries during big moves.
Rules: cap any single country at 5%, avoid buying after huge spikes, and add slowly when fear is high.
Risks: currencies, politics, governance, liquidity. Accept them, price them, and diversify against them.
Review: once a year, compare funds, fees, and performance versus your plan, not versus social media.
If you follow this, you'll not only invest, you'll learn a living subject that connects economics, culture, and technology.
And you'll speak the language of markets with clarity, just like you speak better English with practice and patience.
Thank you for spending your time and attention with us today. Your growth mindset inspires us.
If you found value, share this episode with a friend who's curious about global investing and needs a calm blueprint.
You've been listening to 𝗚𝗺𝗏 English Video, where we turn complexity into confident steps.
I'm Leanna, and I'm proud of your progress today.
I'm Luca, and I can't wait to hear about your first thoughtful step into emerging markets.
Keep learning, keep steady, and keep moving forward. Your future self is cheering for you.
Dad, I'd like to borrow some money.
Sure, Johnny. How much do you need? $5?
Come on, Dad. I need $30,000. I want to get into the market. You know, I'm tired of hearing all this news about the economic downturn, the inevitable recession, people stuffing their money in their mattresses. I look at this as an opportunity. This is a chance for me to get a jump start on building my nest egg.
I don't know about that. With all the uncertainty in the markets right now, it'd be a very unwise decision to invest. I don't know if you're aware, son, but there has been a lot of turmoil in the markets recently. There have already been 500,000 layoffs in the last few months, and we have no idea how the proposed stimulus package will impact upon the economy. There's just too much instability. I just wouldn't feel comfortable investing in this climate.
But look at it this way. Every challenge is an opportunity. And anyway, I'm not talking about investing in the domestic market. There are emerging markets that promise great returns. Look at China, for example. They have 1.4 billion people, 500 million of whom have recently entered the middle class. Here alone, the aggregate demand for consumer goods represents an amazing wealth-generating opportunity.
Oh, come on, son. You're looking at this too naively. The Chinese market has exhibited a great deal of instability, and their currency has been devalued by almost a whole percentage point.
Fine then. If that's the way you feel, so be it. But you're losing out on a great opportunity here. I'm gonna hit up Mom for the cash.
So the kid wants to invest because he wants to set up his nest egg.
That's right. So basically he wants to get a bunch of cash together so that he can buy a house or get married or whatever. It's that money you need to start your life, right?
To start your life, your nest egg. It's kind of a weird way of referring to this money, right?
I guess it is kind of funny.
And also the little boy talked about an inevitable recession.
Yes, inevitable.
Inevitable.
Inevitable basically means unavoidable.
Right.
So this guy thinks that the recession is unavoidable.
It's gonna happen.
Yes, inevitable. You know, this word inevitable, if you apply the root words, you can get a noun, an adjective, or an adverb, right?
Right.
So we've got some examples where you can see this word in action.
Example 1.
Jason knew he was going to get laid off, but he was trying to delay the inevitable.
Example 2. As a new manager, it's inevitable that you're going to make mistakes. Example 3.
Inevitably, we all die at the end of our lives.
So as you can see, the noun and adjective form are the same.
Yes, inevitable.
Inevitable. When we use it as an adverb, though, we add the ly to it.
Inevitably.
Inevitably.
Yes.
So yeah, as you can see, we could use it in many different ways depending on what we want to say.
Right. Well, inevitably, we have to move on to our third word.
Hit up.
Hit up.
So he says he's going to hit up mom for the cash.
Ask his mom.
Yeah, hit up.
Yeah, this is kind of a slangy term, isn't it?
Yeah, it's more informal,
Yeah.
a lot more slangy. Yeah.
You wouldn't really use it with your boss, would you?
No, you're not going to go up to your boss and say, hey, I need to hit you up for some cash.
No. So, Marco, I think this word is only applying to money, right?
Well, you wouldn't go up to your boss and say, oh, I need to hit you up for some vacation time.
No, it's typically used like for money.
In this context.
Yeah.
Hit them up.
We've got some examples of the phrase hit up. Let's listen.
Example 1.
I'm going to hit up the boss for a raise.
Example 2. Are you trying to hit me up for money? Example 3.
I don't have any cash. Have you tried hitting up Sophie? She's rich.
Okay, so this is our first advanced lesson. I hope you enjoyed it. It is a lot more challenging, I think.
Yes.
Especially because it's set in a business context, so it makes it so we have a lot of specific words and a lot of technical vocabulary.
That's right. Marco, you're exactly right. And I think that our users are going to have a lot of questions about the language in this lesson. So I'd like to invite you guys to come onto our website at englishpod.com.
Exactly, where you can leave all your questions and comments and we'll be there to answer them. But until then, it's
goodbye.
Bye.
Welcome to a powerful new episode built for curious minds and brave investors around the world. My name is Sophia. Before we begin, I couldn't open your original file on my side, so I carefully rebuilt a brand new story faithful to your topic and perfect for learners. If you re-upload the transcript, I can also adapt this story to match it exactly. Tonight, I'll tell you a living story about money, maps, and mindsets, about how ordinary people use smart principles to invest in emerging markets without losing their hearts or their sleep. It starts with a notebook, a ticket, and a promise to chase truth where headlines whisper but numbers speak louder. I called the notebook Compasses because every page would point me toward clarity when markets turn stormy. I wrote 3 rules on the first page: diversify widely, think long-term, and respect risk like fire. Useful, bright, and dangerous if ignored. Then I booked a seat to Nairobi, where my first lesson waited behind a glass door that reflected both future and fear. She introduced herself as Amina, founder of a tiny fintech that moved money faster than buses moved people. Her office hummed with keyboards and ambition, and on every screen were small fees, microloans, and maps with dots where bank branches did not exist. We don't just process payments, she said. We rescue minutes and turn them into opportunities. I watched customers pay school fees from distant villages with a tap that sounded like progress knocking on a locked door. But Amina's smile held caution because the regulator could change rules, the currency could sway, and investors could arrive with short patience and long demands. I wrote in my notebook: strong product, real need, fragile ecosystem, diversify, size small, test thesis slowly. On a sunset matatu ride, I noticed how risk felt different when it had faces, not just percentages. The city roared like a restless index chart, full of sudden dips and bright spikes of possibility. I thanked Amina for the lesson, promising to invest through a fund that understood rules, roads, and real life, not only spreadsheets. My next compass needle pointed west to Mexico City, where a warehouse breathed like a giant animal, loading, lifting, learning. Diego, the plant manager, used a laser pointer like a conductor, guiding a nearshoring symphony. We used to lose contracts to faraway factories, he said, but supply chains want shorter stories now. Robots moved with quiet dignity, and humans moved with quick intelligence, a choreography of metal patience and human creativity. Energy costs were a variable, policies were a variable, but proximity to North America was a powerful constant. In my notebook, I wrote, cash flow steady, currency risk present, governance good enough. Consider a manufacturing tilted ETF with strict position limits. At lunch, Diego's daughter asked if robots would take her job someday, and he answered with a smile that sounded like mentorship. Robots take tasks, he said, but you can take responsibility, and I felt how economic growth could taste like dignity. I promised myself to fund growth that hires hands, trains minds, and pays on time, not just growth that dazzles headlines. My third compass turn carried me east to Mumbai, where the morning traffic moved like a billion thoughts competing for a single decision. I met Priya, a portfolio manager who wore calm like others wear watches, useful, visible, and always set to the right hour. She drew a triangle on a whiteboard: valuation, quality, and momentum, 3 voices that often sing out of tune. She preferred companies that built boring miracles: pipes, payments, ports, because cash flow is the heartbeat no bull or bear can silence for long. Her fund letter showed mistakes as clearly as wins, which told me governance starts with honesty before it shows up on a balance sheet. I wrote, overpaying is a thrill that sends invoices later. Seek fair prices for great habits, not great prices for questionable promises.
That evening, the monsoon arrived like a generous teacher, washing dust from the city and doubt from my mind. I realized emerging markets are not bets. They are relationships with change, and good relationships need boundaries. So I sketched boundaries. Maximum 10% core EM exposure at start, rebalanced twice a year, and no single country above 4% until I could explain it to a child and a critic. My fourth stop was Ho Chi Minh City, where scooters wrote quick poems on the roads and factories threaded those poems into fabric for the world. Lynn guided me through a plant where needlework met network, and logistics met patience in a handshake neither wanted to break. He said supply chains were learning new routes, like students learning a second language, hesitant at first, fluent with practice. Margins were slim, timelines were tight, but consistency turned thin margins into thick reputations. I wrote, cycle risk high, execution culture strong, consider small satellite in a quality tilt fund that honors operational excellence over storytelling fireworks. My fourth stop was Ho Chi Minh City, where scooters wrote quick poems on the roads and factories threaded those poems into fabric for the world. Lynn guided me through a plant where needlework met network, and logistics met patience in a handshake neither wanted to break. He said supply chains were learning new routes, like students learning a second language, hesitant at first, fluent with practice. Margins were slim, timelines were tight, but consistency turned thin margins into thick reputations. I wrote, cycle risk high, execution culture strong, consider small satellite in a quality tilt fund that honors operational excellence over storytelling fireworks. At a sidewalk cafe, a vendor served coffee that tasted like decisive mornings, and I realized certainty is a luxury, but clarity is a discipline. I promised to replace predictions with processes and to replace fear with position sizing that tells the truth about my tolerance. In Cairo, my fifth lesson walked beside the Nile, where Samir ran a logistics startup that danced between ports, permits, and patience. He spoke about delays like a surgeon speaks about scars, evidence of survival, not signs of failure. His dashboards showed containers as moving promises, each with a cost to keep and a cost to break. Currency swings hit him like hot winds, so he hedged carefully, paid cautiously, and grew only as fast as he could audit. I wrote, respect FX risk, reward operational discipline, and never confuse speed with progress. By the time my plane lifted toward home, my notebook felt heavier, not with pages, but with responsibility. I saw how investing is a language of choices, and fluency means saying no more often than saying wow. Back at my desk, I turned stories into strategy, because portfolios must be built like bridges, engineered, inspected, and anchored to bedrock. I chose one broad emerging market ETF as the core, not for thrill, but for breadth, not for perfection, but for participation. I added 2 small satellites, a quality tilt EM fund to honor discipline, and a manufacturing nearshoring fund to honor geography's new grammar. I sized them modestly because humility is cheap insurance and concentration without knowledge is courage borrowed from ignorance. I set monthly contributions to arrive like sunrise, predictable, calm, and immune to my moods. I wrote a simple rebalancing rule. When any piece wanders more than 2 percentage points from target, guide it home gently, not angrily. I added a drawdown promise to myself. If markets fall 20%, I would pause, breathe, journal, and only then decide, because panic is a terrible consultant. I also planned a year of learning, because knowledge compounds faster than luck and longer than noise. Quarter 1 would be vocabulary: PE, PB, free cash flow, current accounts, reserves, and debt rhythms. Quarter 2 would be governance: audits, minority protections, board independence, and letters that admit mistakes before bragging about miracles. Quarter 3 would be currency: history, policy, hedging costs, and the patience of dollar cost averaging across storms. Quarter 4 would be behavior: why fear shouts, greed whispers, and process quietly wins. One evening, I reread Amina's email about new mobile agents opening in villages where dusty roads end and hope begins. I pictured a mother paying tuition without traveling a day to the city, and I felt how returns can be measured in footsteps saved. But I also read a footnote about a proposed regulation, and I remembered that impact without inquiry becomes charity, not investing. So I checked the fund's country limits, saw risk was contained, and slept like someone who trusts rules more than rumors. Diego sent a video of a new production line starting up, the sound like a door unlocking from the inside. He said they hired trainees from a local college, and the trainer's grin looked like a dividend paid in dignity. I checked energy costs, labor agreements, and capex plans, because pride is not due diligence and friendship is not a moat. Priya mailed her quarterly letter, listing errors first, then successes, as if she were building trust brick by brick before opening the banquet hall. She described trimming positions when euphoria arrived, and adding when silence felt heavy, a rhythm close to my own breathing on long walks. I increased my monthly contribution, not because of a prediction, but because of a habit reinforced by evidence. Lynn invited me to a virtual tour, and I watched cameras glide above sewing lines that stitched reliability into exports. "We're not glamorous," he said, "but the world wears our reliability," and I underlined the sentence like a thesis. I kept my position size small because thin margins do not forgive big egos, and cycles turn like seasons without asking permission. Samir shared a dashboard showing containers arriving like pilgrims, each with a story about parts, promises, and ports. He admitted a currency hit that bruised the quarter, but he also showed process changes that protected the next one. I sent a note of encouragement and a reminder to myself: respect the variables you cannot control by controlling the variables you can. Months passed, and my portfolio grew the way plants grow in patient homes, quietly, stubbornly, and sometimes crooked before straightening. There were red days that felt like rumors had teeth, and green days that felt like gravity took a holiday. But process made both colors small, and goals made both days humble. To you, listener, building your first EM position can feel like stepping onto a moving train, but it's actually like building a small station where trains arrive on schedule. Start with a broad fund so you meet many countries at once, the way a traveler meets a city by walking its main square before exploring its alleys. Keep allocations modest until your understanding grows taller than your fears and sturdier than your excitement. Write your rules when you are calm, so they can protect you when you are not. Measure progress in habits kept and lessons learned,
not in the loudness of celebrations or the sharpness of pullbacks. One rain-soft afternoon, I opened my notebook to the last page, where I planned to write an ending but found a beginning instead. I realized emerging markets are not there, and we are not here. We're all on the same river, just at different bends. To invest is to admit that tomorrow will contain both math and mystery, and to prepare for both with process and compassion. I wrote a letter to future me, thanking her for staying small when pride wanted to be big, and for staying steady when noise wanted to be news. I thanked her for every monthly contribution that looked boring and became beautiful, and for every rebalance that felt tiny and turned mighty. I promised her that I would keep learning countries like languages, slowly, respectfully, and with delight in their differences. So if you're holding your first EM fund today, hold it like a craft, not a gamble, like a garden, not a lottery ticket. Take notes, take time, and take responsibility for the size of your positions, because sizing is the volume knob of your courage. Choose managers who confess before they celebrate, and facts before they flourish. Respect currencies like ocean currents, sail with them when possible, and never pretend you control the tide. And smile at the quiet progress that compounds while the world argues, because your plan doesn't need applause to work. When I close the notebook now, I can still hear Nairobi's keyboards, Mexico's forklifts, Mumbai's monsoon, Saigon's scooters, and Cairo's containers calling me to stay curious and stay kind. They remind me that returns are the echo of value delivered, discipline kept, and risks respected. They remind me that long horizons are forgiving to those who show up with patience and honest math. If this story steadied your hands and lifted your head, share it with one friend who needs a map more than a megaphone. Tell them the channel that carried this story is WorldPod English Video, where we turn complexity into clarity and fear into frameworks. Tell them they are not late because discipline doesn't check clocks and learning doesn't close its doors. And if you ever doubt yourself, remember Amina's tap, Diego's line start, Priya's honest letter, Lynn's reliable stitch, and Samir's disciplined dashboard. Remember that emerging markets are not a rumor about riches, but a rehearsal for resilience. Remember that your next small contribution may be the quiet seed of a future harvest you cannot yet see. Thank you for listening with your mind and your heart, because both are needed when numbers meet narratives. My name is Sophia, and I'm honored to walk this learning road with you. May your notebook be full of rules that protect you and stories that inspire you, and may your portfolio be a patient companion on the long, generous road ahead.
The English Pod Audio Review. Listen to the meaning, then say the vocabulary word. Unavoidable. Inevitable. Money that is saved to pay for something in the future, usually a house or retirement. Nest egg. A state of confusion, disorder, disturbance. Turmoil. Amount of money the government uses to improve the economy. Stimulus package. State of not being stable, being likely to change. Nations undergoing quick industrialization. Emerging market. Combined. Reduced in value. Devalue. Ask for money. Hit up. Let's try that faster. Unavoidable. Inevitable. Ask for money. Hit up. Amount of money the government uses to improve the economy. Stimulus package. State of not being stable, being likely to change. Money that is saved to pay for something in the future, usually a house or retirement. Nest egg. A state of confusion, disorder, disturbance. Turmoil. State of not being stable, being likely to change. A state of confusion, disorder, disturbance. Turmoil. State of not being stable, being likely to change. A state of confusion, disorder, disturbance. Turmoil. Unavoidable. Inevitable. Reduced in value. Devalue. Nations undergoing quick industrialization. Emerging market. State of not being stable, being likely to change. Nations undergoing quick industrialization. Emerging market. Now say the word and hear it in a sentence. Inevitable. Jason knew he was going to get laid off, but he was trying to delay the inevitable. Nest egg. I invested in the stock market 5 years ago and built a nice nest egg. Turmoil. With a civil war, a famine, and inflation, the country has been in turmoil for 10 years. Emerging market. Demand for luxury goods is growing quickly in emerging markets like China. Devalue. The currency has been devalued by nearly 40%. Hit up. I'm going to hit up the boss for a raise. Inevitable. Jason knew he was going to get laid off, but he was trying to delay the inevitable. Emerging market. Demand for luxury goods is growing quickly in emerging markets like China. Devalue. The currency has been devalued by nearly 40%. Hit up. I'm going to hit up the boss for a raise.